Equiprefs, sweat equity shares, clip and split bonds, etc. Hello friends, I am Advocate Sanjay Arora from New Delhi, India. I welcome all of you to my YouTube channel Legally Determined. Capital market is a market for financial investments that are direct or indirect claims to capital. Capital market is a wider term than the securities market and embraces all forms of lending and borrowing. Capital market includes securities markets. Security market is market where equity shares, preference shares, debentures and bonds are traded. Similarly, securities exist in money market too. Money market is a market for short-term funds which deals in financial assets whose period of maturity is up to 1 year. For instance, call money, treasury bills, commercial paper, certificate of deposit, and trade bill. Security market has the following two segments. First, primary market, also known as new issue market (NIM). The primary market is the market where the securities are sold for the first time. Companies, governments, or public sector institutions can obtain funding through the sale of new shares or bond issue known as IPO or initial public offer. Section 23 of Chapter 3 of Part 1 of the Companies Act 2013 mentions public issue as a way of raising funds through public, meaning thereby the selling or marketing of share for subscription by the public by issue of prospectus. For that, the company has to get listed to the recognized stock exchanges in India. The Companies Act 2013 was amended in 2018, bringing about drastic changes in Section 26 thereof. Matters related to prospectus will now be dealt with by the SEBI Securities and Exchange Board of India in consultation with the central government. The SEBI Issue of Capitals and Disclosure Requirements Regulation 2018, ICDR Regulations and the SEBI Listing Obligations and Disclosure Requirements Regulations 2015. The listing regulations are the two most significant regulations providing for the public issues. The compliance of listing agreement with the concerned stock exchanges after the listing of securities. The Securities Contracts Regulation Act 1956, RBI regulations in case of foreign NRI equity participation are significant too. The SEBI is responsible for the entry norms of a public issue which it does through the SEBI Disclosure for Investor and Protection Guidelines 2000. There is low risk because there is no repayment of capital except when the company is in liquidation. There is no rate of interest to be paid resulting in financial burden, but the procedure is time consuming. The issue of securities by companies can take place in any of the following methods. Initial public offer IPO as described above. Second, FPO follow-on public offer also known as further public offer. FPO is the subsequent issue to the public after initial public offer IPO. A company can either issue fresh issues or offers its existing securities to public. However, if the same company comes out with another issue to the public, the second issue would be called an FPO. There are two ways wherein a company can conduct its follow-on public offer. In the dilutive FPO, the company board issues a new set of shares to be offered to the public to fund expansion activities or pay for debts. In the non-dilutive FPO, the existing shareholding does not get diluted. The shares issued in a non-dilutive FPO are those that are already in existence, meaning thereby that it is the directors or the bigger shareholders who sell their shares and offer them to the public. The non-dilutive FPO does not carry any material benefits for the company. Mostly it is used to change the shareholding ownership pattern. The issue price for an FPO is mostly lower than the prevailing market price. This is done by the company to get more and more subscribers to its issue. Lower demand for the listed share eventually brings down the market price and levels it with the FPO issue price. The existing shareholders desire to offload their shareholding in the company, called offer for sale or OFS. In an OFS, the FPO proceeds are not deposited with the company but delivered to the existing shareholders. A listed company which has defaulted in interest payment or repayment of the principal amount in respect of debt instrument issued to the public is not permitted to promote an FPO of convertible debt instruments. As per Section 42 2 of the Companies Act 2013, read with Rule 14 of the Companies Prospectus and Allotment of Securities Rules 2014, any offer by a company, listed or unlisted, to allot or invitation to subscribe or allotment of securities to more than 200 persons in the aggregate in any financial year shall be deemed to be an offer to public. Third, rights issue. Section 62 of the Companies Act 2013. A rights issue is made to the existing shareholders. A rights issue is also a way to raise funds. When a company expands, it requires additional funds when a company is into a project where debt or loan funding is not available or expensive, or when the companies are looking for improvement in the debt to equity ratio or planning to buy a new company. One of the many ways to raise additional capital for a listed company is rights issue of shares. If a company issues shares to the public at large, it may affect the voting rights of the existing shareholders of the company. Types of rights issue of shares. First, fully paid rights issue, where an applicant has to pay the entire issue amount at the time of the application, is called a fully paid rights issue. Second, partly paid rights issue, where an applicant is required to pay only a part amount at the time of the application, is called a partly paid rights, while the balance amount is to be paid as and when the company makes the subsequent calls. Third, renounceable rights issue. The rights issue can be transferred or sold in the open market to other investors. Fourth, non-renounceable rights issue. A non-renounceable rights issue cannot be transferred or sold to anyone. Firm allotment. When a company issues certain percentage of shares to the public, the remaining shares are allotted to different categories of investors. Such an allotment is known as firm allotment. Given below is the percentage of shares that can be allotted to different categories of investors. Foreign financial institution investors 30%, development financial institutions 20%, Indian mutual funds 20%, permanent regular employees 10%, lead bankers 5%, employees of the promoting companies 10%. The balance can be taken by the promoters. Fifth, bonus issue. In a bonus issue, new securities are issued to the existing shareholders without any consideration. Bonus shares are issued by a company when it is not able to pay a dividend to its shareholders due to the shortage of funds in spite of earning good profits for that quarter. Issuing bonus shares to the existing shareholders is also called capitalization of profits because it is given out of the profits of reserves of the company. Record date is a cutoff date set by the company. If you are the owner of the shares of the company on this cutoff date, you are eligible to receive the bonus shares. There is no need for investors to pay any tax on receiving bonus shares. When the company declares a dividend in future, the investor will receive higher dividend because now he holds larger number of shares in the company due to bonus shares. The conditions for issue of the bonus shares. First, bonus shares must be authorized by the articles of the company. Second, must be recommended by the resolution of the board of directors, and this recommendation must be later approved by the shareholders of the company in the general meeting. Third, the controller of capital issues must give permission to the issue. Section 270 of the Companies Act 2013 defines prospectus as any document described or issued a prospectus and includes a red herring prospectus, shall prospectus, any notice, circular, advertisement or other document inviting offers from the public for the subscription or purchase of any securities of a body corporate. The conditions for issue of bonus shares. It has been discussed. Shell prospectus. In a shell prospectus, there would be one prospectus that would be used for numerous issuance offerings. A prospectus is a legal document that offers information about an investment offering for sale to institutional investors or the public at large, known as retail investors. In India, there are typically two types of IPO prospectus: draft red herring prospectus (DRHP), also known as preliminary prospectus; red herring prospectus (RHP), also known as final prospectus, Section 32 of the Companies Act 2013. The main difference between a DRHP and RHP is that DRHP is not an official offer to sell the security. On the other hand, the final prospectus is an official document and includes the price of the sold securities. Once approved, DRHP becomes RHP containing the details of the issue. Red herring prospectus is an incomplete prospectus which are issued to public without mentioning the number of shares to be issued and price of them. If a company is issuing a prospectus and it is not sure about what should be the price of shares, they have an option to issue red herring prospectus without mentioning price and number of shares and file the same provisionally to the ROC. This type of prospectus is generally issued under the book building process where company let people decide its price by accepting bids from them and announcing cut-off list according to amount they want to raise. Abridged prospectus is that it makes a summarized form of prospectus by cutting out slack from main prospectus and issue these summarized prospectus to public. The same is called abridged prospectus. The prospectus contains a lot of things that it can be too big for a company to print those large prospectus to public. The same is called abridged prospectus. Every investor who wants to invest in a company can on demand have a copy of main prospectus at any branch of company. Offer document has three types: draft offer document, second red herring document, third abridged prospectus, as we have seen before. After incorporation, a company decides to raise capital from public. In order to do so, it has to inform the public that it is issuing its securities in consideration of their money. So it will inform the general public by issuing a notice or advertisement circular that is called offer document. Offer document is called letter of offer in case of rights issue. Secondary market, also known as aftermarket. The secondary market is the financial market where previously issued securities and financial instruments such as stock, bonds, options, and futures are bought and sold. Secondary market has two components. First, spot market, where securities are traded for immediate delivery and payment. Second, futures market, where the securities are traded for future delivery and payment. Meaning of debt market. Debt instruments include debentures, bonds, notes, and mortgages. The debt market is the market where debt instruments are traded. Debt instrument holders are creditors of the issuing companies. Debt market is less volatile. Investments in debt securities typically involve less risk than equity instruments. In debt market, there is less risk, hence returns are also low. Income of debt market is fixed. Meaning of equity market. The equity market is the market where equity and preference shares are traded. Equity holders are the owners of the issuing companies. Equity market is more volatile than debt market. Investments in equity market typically involves more risk than debt investments. Income in equity market is variable. Instruments in capital market can be classified into three categories. First, pure investment instruments. Second, hybrid instruments. Third, derivative instruments. First, instruments. Equity shares, preference shares, debentures and bonds which are issued with their basic characteristics without mixing the features of other instruments are called pure instruments. Pure instruments are beneficial but not like hybrid instruments. Second, hybrid instruments, instruments which are created by combining the features of equity, preference, bond are called as hybrid instruments. For instance, convertible preference shares, convertible debentures, non-convertible debentures with equity warrant, partly convertible debentures, secured premium notes. Hybrid instruments are more beneficial than pure instruments. Derivative instruments. A financial instrument which derives its value from the value of some other financial instrument or variable, for instance, futures and options. About share. Share section 284 of the Companies Act 2013. A share means a share in the share capital of a company and includes stock. Nature of shares and debentures. Section 44. A share or debentures or other interest of any member in a company is a movable property transferable in the manner provided by the articles of the company. Numbering of shares. Section 45 of the Companies Act 2013. Each share in a company having a share capital shall be distinguished by distinctive number. Kinds of share capital. Section 43. One of the Companies Act 2013. The share capital of a company limited by shares shall be of two kinds, namely A. Equity share capital with the voting rights or with differential rights as to dividend, voting or otherwise. B. Preference share capital. Equity share capital. The rate of dividend on equity share depends upon the amount of profit available and the funds requirement of the company for future expansion, etc. The dividend on equity shares is paid only after the preference dividend has been paid. In case of winding up, equity shares holders get payment of capital after the payment of capital to preference shareholders. The dividend on equity is not cumulative. An equity shareholder can vote on all matters affecting the company. The voting rights of preference shareholders are restricted. A preference shareholder can vote only when his special rights as a preference shareholder are being varied or any resolution for the winding up of the company or for the repayment or reduction of its equity or preference share capital, or if their dividend has not been paid for a period of 2 years or more. Section 47, subsection 2 of the Companies Act 2013. A company may issue right share or bonus shares to the company's existing equity shareholders. No bonus shares or rights issues are issued to preference shareholders. Equity shares cannot be redeemed except under a scheme involving reduction of capital or buyback of its own shares. Equity shares, Section 43, subsection 2 of the Companies Act 2013. Equity share capital with reference to any company limited by shares means all share capital which is not preference share capital. Shares with differential voting rights (DVR). Shares with differential voting rights means a share issued with differential right as to dividend voting or otherwise in accordance with Section 43A 2 of the Companies Act 2013. Rule 4 of the Company Share Capital and Debentures Rules 2014 makes the following provisions relating to the issue of shares with DVR. First, conditions for issuing shares with differential rights. Rule 4, Subrule 1. The Articles of Association (AOA) authorizes the issue of shares with differential rights. The issue of shares is authorized by an ordinary resolution passed at a general meeting. In case of listed company, the issue shall be approved by the shareholders through postal ballot. The shares with differential rights shall not exceed 26% of the total post-issue paid-up equity share capital, including equity shares with differential rights at any point of time. Company should have consistent track record of distributable profits for the last 3 years. Company has not defaulted in filing financial statements and annual returns for the last 3 financial rights. Company has no subsisting default in the payment of a declared dividend to its shareholders or repayment of its matured deposits or redemption of its preference shares or debentures that have become due for redemption or payment of interest on such deposits or debentures or payment of dividend. Company has not defaulted in payment of the dividend on preference shares or in repayment of principal or interest or any item loan from a PFI or state level financial institution or scheduled bank. In dues with respect to statutory payments relating to its employees to any authority, in crediting the amount in Investor Education and Protection Fund to the central government, company has not been penalized by court or tribunal during the last 3 years of any offence under the Reserve Bank of India Act 1934, the Securities Exchange Board of India Act 1992, the Securities Contracts Regulation Act 1956, the Foreign Exchange Management Act 1999, or any other special act. Disclosure in the explanatory statement. Rule 4, Subrule 2. The explanatory statement to be annexed to the notice of the general meeting shall contain the prescribed particulars like number of shares, percentage of the shares, reasons or justification for the issue, etc. Conversion. Rule 4, Subrule 3. The company shall not convert its existing equity share capital with voting rights into equity share capital carrying differential voting rights (DV) or also vice versa. Disclosure in the board's report. Rule 4, Subrule 4. The board of directors shall disclose in the board's report the following details, namely number of shares allotted with differential rights, details of the differential rights relating to voting rights and dividends, percentage of the shares with differential rights to the total post-issue equity share capital with differential rights issued at any point of time, and percentage of voting rights which the equity share capital with differential voting rights shall carry to the total voting rights of the aggregate equity share capital. Price at which shares have been issued, particulars of promoters, directors or key managerial personnel to whom such shares are issued, change in control if any in the company consequent to the issue of equity shares with differential voting rights. Diluted EPS, earnings per share, calculated in accordance with the applicable accounting standards. The pre and post issue shareholding pattern along with voting right. Rights of holders of equity shares with differential voting rights. Rule 4, Subrule 5. The holders of the equity shares with differential rights shall enjoy all other rights such as bonus shares, right shares, etc., which the holders of equity shares are entitled to, subject to the differential rights with which such shares have been issued. Register of members. Rule 4, Subrule 6. When company issues equity shares with differential rights, the register of members maintained under Section 88 of the Companies Act 2013 shall contain all the relevant particulars of the shares so issued along with details of the shareholders form number MGT2. B. Preference share capital. Section 43 2 of the Companies Act 2013 preference share capital with reference to any company limited by shares means that part of the issued share capital of the company which carries or would carry a preferential right with respect to payment of dividend either as a fixed amount or at a fixed rate and repayment in the case of winding up or repayment of capital as specified in the memorandum or articles of the company. The following kinds of preference shares are dealt with by the companies. First, cumulative preference shares. Second, non-cumulative preference shares. Third, convertible preference shares. Fourth, redeemable preference share. Fifth, participating preference shares. Sixth, non-participating preference shares. Cumulative preference shares. A preference share is said to be cumulative when the arrears of dividend are cumulative and such arrears are paid before paying any dividend to equity shareholders. For instance, a company has 10,008% preference shares of 100 rupees each. The dividends for the last years have not been paid so far. The directors, before they can pay the dividend to equity shareholders, the year 2021 must pay the preference dividends of 2,40,000 rupees, 80,000 multiplied by 3 years. If a company goes into liquidation, no arrears of preference dividend will be payable unless the articles of association of the issuing company contains a specific provision to make such payment even in winding up. Non-cumulative preference shares. In the case of a non-cumulative preference shares, dividend does not accumulate. The dividend is only payable out of the net profits of each year. If there are no profits in any year, the arrears of dividend cannot be claimed in the subsequent years. The dividend on the preference share lapses if not paid by the company during a particular year. Preference shares are cumulative unless expressly stated to be non-cumulative. Convertible preference shares. Convertible preference shares are those shares which can be converted into equity shares within a certain period if the terms of issue. It was held that where the equity shares are to be converted into redeemable preference shares, it was necessary to adopt the process of reduction of capital under Section 66 of the Companies Act 2013. Redeemable preference shares. A company limited by shares may, if so authorized by its articles, issue preference shares which are redeemable as per the provision laid down in Section 55. Shares may be redeemed either after a fixed period or earlier at the option of the company. Issue and redemption of preference shares. Section 55 of the Companies Act 2013. A company limited by shares shall not issue preference shares which are irredeemable. A company limited by shares may issue preference shares which are liable to be redeemed within a period of 20 years from the date of issue. A company may issue preference shares for a period exceeding 20 years for infrastructure projects, subject to the redemption of such percentage of shares as may be prescribed on an annual basis at the option of such preferential shareholders. Out of the profits available for dividend, out of the proceeds of a fresh issue of shares, preference shares shall be redeemed unless they are fully paid up. Where preference shares are proposed to be redeemed out of the profits of a sum equal to the nominal amount of the shares should be transferred to the capital redemption reserve account. Premium payable on redemption of any preference shares shall be provided for out of the profits or out of the securities premium account before such shares are redeemed. Participating preference shares. Normally, preference shareholders are not entitled to dividend more than what has been indicated as part of the terms of issue, even in a year in which the company has made hefty profits. In case of participating preference shares, holders are entitled to participate in the surplus profits left after the payment of dividend to the preference and the equity shareholders to the extent provided therein. Subject to provisions in the terms of issue, such preference shares can be entitled even to bonus shares. Non-participating preference shares. Non-participating preference shares are entitled only to a fixed rate of dividend and do not share in the surplus profits. Non-participating preference shares are presumed to be non-participating unless expressly provided in the memorandum or the articles or the terms of the issue. About share warrants. A share warrant is a bearer document of title to shares and can be issued only by public limited companies and then that to against fully paid up shares only. A share warrant is transferable by mere delivery of the warrants without execution of any written instrument of transfer being registered by the company. The bearer of a share warrant is not a member of the company unless otherwise so provided in the articles of the company. The share warrants are negotiable instruments. Coupons are attached to each warrant bearing the dates on which the dividend will be paid by the company, as they cannot know who the shareholders or who is entitled to the dividends. The person who produces the appropriate coupon can receive payment of the dividend. Since warrants are essentially a right or interest in securities, it shall be treated as a security under Clause H of Section 2 of the Securities Contracts Regulation 1956. According to Section 2, subsection 81 of Companies Act 2013 says security means the security as defined in Clause H of Section 2 of the Securities Contracts Regulation Act 1956. VIDE RBI notification number FEMA 308/2 2014 RB2 dated June 30, 2014. RBI clarified that warrants shall be treated as security within the meaning of Section 2, subsection ZA of the FEMA. About sweat equity shares, Section 2, subsection 88 of the Companies Act 2013 deals about sweat equity shares. So, sweat equity shares means sweat equity share means equity shares issued by a company to its directors or employees at a discount or for consideration other than cash for providing know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. Issue of sweat equity shares. Section 54 of the Companies Act 2013. A company can issue sweat equity shares of a class of shares already issued if the following conditions are satisfied. The issue has been authorized by a special resolution passed by the company in the general meeting. Such special resolution should specify number of shares, current market price, consideration, classes of directors or employees to whom such equity shares are to be issued. At least 1 year should have elapsed from the date on which the company was entitled to commence business. A company whose shares are listed on a recognized stock exchange issuing sweat equity shares should comply with the SEBI issue of sweat equity regulations 2002. A company whose shares are not listed on a recognized stock exchange should comply with the company's share capital and debenture rules 2014. The rights, limitations, restrictions and provisions as are for the time being applicable to equity shares shall be applicable to the sweat equity shares issued, and the holders of sweat equity shares shall rank pari passu with other equity shareholders under section 54 subsection 2. Register of sweat equity shares. Rule 8, Subrule 14 of the company's share capital and debenture rules 2014. The company shall maintain a register of sweat equity shares in form number SH3 and shall forthwith enter therein the particulars of issue of sweat equity shares. The register of sweat equity shares shall be maintained at the registered office of the company or such other place as the board may decide. The entries in the register shall be authenticated by the company secretary or by any other person authorized by the board for this purpose. Provisions of the company's share capital and debenture rules 2014 relating to sweat equity shares are as follows. Explanatory statement to contain certain particulars. Rule 8 Subrule 2. The explanatory statement to be annexed to the notice of the general meeting shall contain the prescribed content like the date of the board meeting, reasons or justification for the issue, the class of shares under which sweat equity shares are intended to be issued, total number of shares, etc. Validity of Special Resolution Rule 8 Subrule 3. The special resolution shall be valid for making the allotment up to period of 12 months. Limits on issue of sweat equity shares. Rule 14. The company shall not issue sweat equity shares for more than 15% of the existing paid up equity share capital in a year or shares of the issue value of 5 crore rupees, whichever is higher. The issuance of sweat equity shall not exceed 20%, 25% of the paid up equity share at any time. Lock-in period rules 8 Subrule 5. The sweat equity shares issued to directors or employees shall be locked in for a period of 3 years from the date of allotment, and this act shall be stamped in bold on the share certificate. Valuation aspects Rule 8 Subrule 6, 7, 8. The sweat equity shares to be issued shall be valued at a price determined by a registered valuer as the fair price, giving justification for such valuation. The valuation of intellectual property rights or of know-how or value addition shall be carried out by a registered valuer. A copy of the valuation report shall be sent to the shareholders with the notice of the general meeting. Issue for non-cash consideration Rule 8 Subrule 9. When sweat equity shares are issued for a non-cash consideration on the basis of a valuation report obtained from the registered valuer, Such non-cash consideration shall be treated in the following manner in the books of accounts of the company, where the non-cash consideration takes the form of a depreciable or amortizable asset. It shall be carried to the balance sheet of the company in accordance with the accounting standards. In other cases, it shall be expensed as provided in the accounting standards. Forms part of managerial remuneration rule 8 sub-rule 10. The amount of sweat equity shares issued shall be treated as part of managerial remuneration for the purpose of sections 197 and 198 of the Companies Act 2013 if the following conditions are fulfilled, namely, the sweat equity shares are issued to any director or manager or they are issued for consideration other than cash, which does not take the form of an asset, which can be carried to the balance sheet of the company in accordance with the applicable accounting standards. Sweat equity shares and compensation aspects rule 8 Sub-rule 11 and 12. If sweat equity shares issued pursuant to no acquisition of an asset, the accounting value or fair value of sweat equity shares shall be treated as a form of compensation to the employee or the director in the financial statements. If the shares are issued pursuant to acquisition of an asset, the value up to valuation report shall be carried in the balance sheet as per the accounting standards and excess value over the value as per valuation report shall be treated as a form of compensation to the employer or the director in the financial statements of the company. Disclosure in board's report rule 8 sub rule 13 the details of issue of certificate shares shall be disclosed in the director's report for the year. Maintenance of register rule 8 sub rule 14 the company shall maintain a register of certificate shares in form number SH3. The register shall be maintained at the registered office of the company or such other place as the board may decide. The entries in the register shall be authenticated by the company secretary or by any other person authorized by the board. About debenture, section 2, uh, subsection 30, Companies Act 2013. Debenture includes debenture stocks, bonds, or any other instrument of a company evidencing a debt, whether constituting a charge on the assets of the company or not. Characteristics of debenture. Debenture is issued by a company as a certificate of indebtedness. Debenture indicates the date of redemption and also provides for the repayment of principal and payment of interest at specified date or dates. Debenture usually creates a charge on the undertaking or the assets of the company. Debenture holders do not have any voting rights. Interest on debentures is compulsorily required to pay even if there is no profit to the company. Debenture cannot be forfeited for non-payment of call. Types of debenture. Debentures are issued in the following form: naked or unsecured debentures, secured debentures, redeemable debentures, perpetual debentures, bearer debentures, registered debentures. Naked or unsecured debentures. Naked or unsecured debentures do not carry any charge on the assets of the company. The holders of such debentures do not therefore have the right to attach particular property by way of security as to repayment of principal or interest and thus called as naked or unsecured debentures. Secured debentures, debentures that are secured by a charge of the whole or part of the assets of the company are called mortgage debentures or secured debentures. After creating charge on debentures, a charge is required to be registered with ROC within 30 days of creation. Redeemable debentures. Debentures that are redeemable on the expiry of certain period are called redeemable debentures. Perpetual debentures if the debentures are issued subject to redemption on the happening of a specified event which may not happen for an indefinite period, for instance winding up, they are called perpetual debentures. Bearer debentures, such debentures are payable to bearer and are transferable by mere delivery. The name of the debenture holder is not registered in the books of the company, but the holder is entitled to claim interest and principal as and when due. A bona fide transferee for value is not affected by the defect in the title of the transferee. Registered debentures. Such debentures are payable to the registered holders whose name appears on the debenture certificate and is registered on the company's register of debenture holders maintained as per section 88 of the Companies Act 2013. Based on convertibility, debentures can be classified under three categories: fully convertibility debenture (FCDs), non-convertibility debentures (NCDs), partly convertibility debentures (PCDs). Fully convertibility debentures (FCDs) are converted into equity shares of the company with or without premium as per the terms of the issue of the expiry of specified period. If the conversion is to take place at or after 18 months from the date of allotment but before 36 months, the conversion is optional on the part of the debenture holders in terms of SEBI ICDR Regulation 2009. Interest will be payable on these debentures up to the date of conversion as per transfer issue. The full value of debenture is converted into equity shares. FCDs are better suited for companies without established track record, highly favorable debt equity share. FCDs are classified as equity for debt equity ratio. FCDs are highly popular with investors. Non-convertibility debentures (NCDs). These debentures do not carry the option of conversion into equity shares and are therefore redeemed on the expiry of the specified period or periods. Partly convertibility debentures (PCDs). These may consist of two kinds, namely convertible and non-convertible. The convertibility portion is to be converted into equity shares at the expiry of specified period. The non-convertibility portion is redeemed at the expiry of the stipulated period. If the conversion takes place at or after 18 months, the conversion is optional at the discretion of the debenture holder. PCDs are better suited for companies with established track record. PCDs have relatively lower equity capital on conversion of debentures. Convertibility Convertible portion is classified as equity and non-convertibility portion as debt. PCDs are not so popular with investors. Characteristics of convertible debentures. Debentures are issued for cash at par. Debentures are converted into specified or unspecified number of equity shares at the end of the specified period. The ratio at which the convertible debentures are exchanged for equity shares is known as conversion price or conversion ratio. Convertible debentures is equal to face value of a convertibility debenture or convertible debenture divided by conversion price. For instance, if the face value of a convertible debenture is 100 rupee and it is convertible into equity shares, the conversion price is 50 rupees. Conversion ratio will be 2. The difference between the conversion price and the face value of the equity share is called conversion premium. If one or more parties of the debentures are convertible after 18 months, a company should get a credit rating done by a credit rating agency. Fresh rating is required if debentures are rolled over. It means debentures are renewed. Company can pay interest at the rates they considered reasonable. Hybrid instruments, bond, a debt instrument issued for a period of more than 1 year with the purpose of raising capital by borrowing. A bond is a promise to repay the principal along with interest. Interest means coupons on a specified date, maturity date. Some bonds do not pay interest, but all bonds require a repayment of principal. When an investor buys a bond, he becomes a creditor of the issuer. The buyer does not gain any kind of ownership rights to the issuer, unlike in the case of equities. Bond rating. It determines a company's credit risk. I am telling you the terminology of the bonds. The classification of fixed income securities. Fixed income securities are classified according to the length of time before maturity. These are three main. There are three main categories: bills, debt securities. Maturities in less than 1 year are known as bills. Notes, debt securities maturing in 1 to 10 years are called notes. Third, bonds, debt securities maturing in more than 10 years are known as bonds. Common stock means equity shares, coupon means interest, face value means par value or principal, yield, the figure or return on a bond, par value also known as face value of a or coupon value. This is the value written on the face of the certificate. Redemption price, the price at which bonds can be redeemed at par, premium or discount. Coupon rate, the interest rate written on the face of the bond certificate. Maturity date, the date on which the face value along with premium, if any, on the bond is repaid. Callable bond. This is the bond where the issuer has the right to redeem the bonds before the maturity date. The issuer redeems the bond when interest rate drops down. For instance, ABC Limited issue bonds of 500 crore rupees at 12%. 2 years later, market rate of interest is 10%. ABC Limited can now raise bonds at 10% if it had built a call option and settle the old bond of 12%. This reduces the interest rate of ABC Limited considerably. Long means bought position, short means sell position. The methods of interest payments in bonds: fixed rate, floating rate, or zero coupon rate. Fixed rate. Most bonds still pay a traditional fixed interest rate. Where a bond's interest rate is fixed to maturity, when a rate is fixed for interest payment of debenture or bond, it is known as fixed coupon rate. A bond which has fixed coupon rate is known as fixed rate bond. The benefit of owning a fixed rate bond is that investors know with certainty how much interest they will earn and for how long. An investor who is willing to take less risk and desires to have constant fixed income on his investment generally invest in fixed rate bonds. Floating rate. Some bonds pay an interest rate that varies and is typically adjusted periodically according to an index tied to short-term T-bills or money markets. Such bonds offer protection against future increases in interest rates, and in exchange, their yields are typically lower than those of comparable fixed rate bonds. When rate of interest on debenture or bond is linked with the index or benchmark rate, it is known as floating coupon rate. A bond which has floating coupon rate is known as floating rate bond or variable rate bond or floater. Floaters offer protection against future increases in interest rates, but investor is not sure about return they will get on their investments. Investor who is willing to take more risk and desire to have his income similar to market generally invest in floaters. Zero coupon rate. These bonds have no periodic interest payments. Instead, they are sold at a deep discount to face value and redeemed for the full face value at maturity, with the difference between that discount and the full face value representing the interest amount. About Equipref. Fully convertible cumulative preference shares. Equipref is in two parts, A and B. Part A is convertible into equity shares automatically and compulsorily on the date of allotment without any participation by the allottee. Part B is redeemed at par or converted into equity after a lock-in period at the option of the investor at a price 30% lower than the average market price. The dividend is given for Part B shares. Upon conversion of each part, the face value stands reduced proportionately on the date of conversion. Secured Premium Notes (SPNs). SPNs. Secured Premium Note is a kind of non-convertible debenture NCD attached with warrant, namely option. The SPN is a hybrid security. It combined both features of equity and debt products. SPN can be only issued by the listed companies after having approval from the central government. Characteristics of a secured premium note. SPN instruments are issued with a detachable warrant. SPNs have lock-in period for 4 to 7 years. No interest is paid during the lock-in period. The detachable warrants are convertible into equity shares provided the SPNs are fully paid. The conversions of detachable warrants into equity has to be done within the specified time. After the lock-in period, the holder has an option to sell back the SPN to the company at par value. If the holder exercises this option, no interest or premium is paid on redemption. In case the holder keeps his investment further, he is repaid the principal amount along with the additional interest or premium on redemption in installments. SPNs were so formulated that the return on investment was treated as capital gain and not regular income. Consequently, the rate of tax applicable was lower. TISCO, Tata Iron and Steel Company, took the lead in July 1992 by making a mega rights issue of equity shares and secured premium notes. Meaning of warrants. Warrant here does not mean share warrant. Warrants are securities that give the holder the right but not the obligation to buy a certain number of securities. Usually the issuer's common stock, namely equity shares, at a certain price before a certain time. Occasionally, companies offer warrants for direct sale or give them to employees as incentive, but the vast majority of warrants are attached to newly issued bonds or stock. About equity shares with detachable warrants. The holder of the warrant is eligible to apply for the specified number of shares on the appointed date at the predetermined price. These warrants are separately registered with the stock exchanges and traded separately. The practice of issuing non-convertible debentures with detachable warrants also exists in the Indian market. Dual option warrants. Equity shares or debentures may be issued with two warrants. One warrant gives rise to the purchaser to be allotted one equity share at the end of a certain period, and another warrant gives right to purchase debt or preference share option. Dual option warrants provide the buyer good capital appreciation. Dual option warrants have limited downside risk. Dual option warrants may be used to sell equity shares in different markets. Debt for equity swap. Debt for equity swap instrument gives an offer to the debt holders to exchange the debt for equity shares of the company. Converting debt to equity occurs when the debt holder converts a debt amount into equity shares. No cash exchange occurs in the debt to equity swap. Advantages to the issuer company. It improves the debt equity ratio when debt is converted in equity. After conversion of debt into equity shares, interest burden is replaced with dividend burden. In case of debt, interest is compulsorily payable, but when debt is converted into equity, it is at the option of the company to declare and pay dividend. Disadvantages to the issuer company. When debt is converted in equity, it increases equity shares and EPS will be reduced. Dividends are not deductible against taxable profit, hence it increases tax burden of the company. Indexed rate notes. Indexed rate means an interest rate linked to an index, uses a consumer price index CPI. In indexed rate notes, the index rate fixation is postponed till the actual date of placement and not on the date of the commitment. This means interest is paid at the rate of interest rate on the date of payment of interest, and interest rate is not fixed at the date of issue. Investor by subscription of index rate notes can keep their return at par with market or index rate. Unlike traditional debt security, the investor gets only fixed rate. Interest rate is based on some other benchmark rate like 182 days treasury bill yield rates. No put option is available in indexed rate notes. Extendable notes. Extendable notes are issued for 10 years with flexibility to the issuer to review the interest rate every 2 to 3 years. Interest rate reflecting market rate of interest is fixed but reviewed after 2 years. Investors have a put option at par value every 2 years, namely, they have the right to sell the bond to the issuer at a fixed rate on the expiry of every 2 years. If maturity is extended, the issuer continues to pay interest, thus, extendable notes usually sell at a higher price than other bonds because there is the possibility for a higher return. Level pay floating rate notes. Level pay floating rate notes are issued for a long period of time, say 20 years, with adjustment in interest rate every 5 years. Level pay floating rate notes provide for level payments for time intervals during the term of the note with periodic interest adjustments tied to an index and adjustments to the principal balance to reflect the difference between the portion of the payment allocable to interest and the amount of floating rate interest actually incurred. Maximum limits on upward adjustments to principal are specified at the outset to protect the lender from runaway floating exposure. The level play floating rate notes have the advantage to the issuer having a predictable level of debt service for a period of years, thereby keeping the uncertainties of floating debt at bay on cash flows during that time. Zero coupon convertible notes. Zero coupon convertible notes is an instrument that is a combination of a zero coupon bond and a convertible bond. Due to the zero coupon feature, the bond pays no feature and is issued at a discount to par value, while the convertible feature means the bond is convertible into common stock of the issuer at a certain conversion price. These are debt convertible into equity shares of the issuer. If investors choose to convert, they forego all accrued interest and unpaid interest. These convertibles are generally issued with put options, sell back and redeem to the investor. The advantage to the issuer is the raising of convertible debt without heavy dilution of equity. Since the investors give up acquired interest by exercise of conversion option, the conversion option may not be exercised by many investors. Explanation: debt to par value. If debt securities issued at the discount price, say 90 rupees, and on maturity investor gets its face value, say 100 rupees, such issue of debt security is known as issued at discount to par value. Investors' return is difference between issue price and face value, namely 10 rupees in this case. Deep discount bonds, a bond that sells at a significant discount from par value is known as deep discount bond. The investors can withdraw from the investment periodically after 5 years. The capital appreciation is changed to tax at capital gain rate, which is lower than normal income tax rate. Easy exit bonds. Easy exit bond has a maturity period of 10 years with a call option with a face value. This instrument covers both bonds which provide liquidity. Easy exit bond enables the small investors to encash the bond at any time after 18 months of its issue and paves a way for an easy exit and an easy exit route to the investor by way of redemption or buyback where investors can get ready encashment in case of need to withdraw before maturity. Pay in kind bonds. Pay in kind bonds are bonds that pay interest in additional bonds rather than in cash. The bond issuer incurs additional debt to create the new bonds for the interest payments. Original bond is called parent bond and bonds issued for payment of interest are called baby bonds. Pay in kind bonds are used by the issuer when the company runs into liquidity problems. Split coupon bonds. Split coupon bond begins at a zero coupon bond paying no interest and converts to an interest paying bond on a future bond. Split coupon bond is also known as zero coupon convertible bond. Split coupon bond is usually issued by companies who do not want to pay cash interest for the first few years of a bond's life. Clip and slip bonds, also known as coupon notes. In the olden days, coupons were attached to the bond and the bondholder clipped off and presented at a bank in exchange for a payment. Most bonds, a coupon bond came due every 6 months. If you had a 10-year bond, these would be 20 coupons attached to the bond. In a strip bond, the bank strips off the coupon from the bond and the investor was left with just the bond. Split the principal and coupon portion of a bond issue and the two separate coupon instruments are sold to the investors. It is issued at a discounted value. Investors gain in difference between face value and discounted value. Disaster bonds. Disaster bond is a debt instrument in which rate of interest is not fixed. The rate of interest or return to investor will depend upon the risk or occurrence of casualty or disaster. If there is disaster, investor will get low return. If there is no disaster, investor will get higher return. Dual convertible bonds. A dual convertible bond is convertible into either equity shares or preference shares or debentures at the option of the investor or lender. About stepped coupon bonds, also known as dual coupon bond, rising coupon securities, step up coupon security. Stepped coupon bond is a callable bond with a low coupon rate that gradually increases step up. It means step up over the life of the bond. The increase occurs at regular intervals stated in the bond. Industrial revenue bonds, IRB in short, IRBs are tax-exempt loans issued by state or local governments to finance a private company's expansion, construction, or acquisition of manufacturing facilities and equipment. Local and state governments support these projects because they can improve the economic well-being of a community. IRBs are issued at rates lower than conventional bonds because interest paid on the bonds may be exempted from income tax. The lower interest rate reduces the cost of financing and makes projects more attractive to pursue. These bonds can mature in 20 to 30 years. IRBs are used to support a specific project like airports, docks and wharves, mass commuting facilities including high-speed rail, facilities for furnishing water, sewage facilities, solid waste disposal facilities, facilities for the local furnishing of electricity, energy or gas, facilities for local district heating and coding, qualified hazardous waste facilities. Commodity bonds. Commodity bonds are bonds issued to share the risk and profitability of future commodity prices with the investor, for instance, petrol bonds, silver bonds, gold bonds, and coal bonds. These bonds are issued to hedge against inflation because the price of commodities usually rises over the time. Investments in some commodities may yield higher return than investment in security bonds. Investors cannot hold such assets physically. About third party convertible debentures. Third party convertible debentures are similar to convertible debentures with warrant option, except that these debentures give an option to the investor to subscribe for shares in another company. The coupon rate on these debentures are lower than the pure debt in view of the warrant option. These instruments are suitable for high profile companies raising sources for greenfield projects. Keratin stick bonds, a variant of the traditional convertible bond with a low conversion premium to encourage early conversion known as the carrot, and a provision which allows the issuer to call the bond at a specified premium if the common stock is trading at a relatively modest percentage above the conversion price, the stick. Capital Index Bonds (CIB), also known as inflation linked bonds. Capital Index Bonds are inflation protection securities. Capital Index Bonds can be used as a market indicator for inflation expectation. The instrument will initially carry a face value of 100 rupees. Instead of offering a nominal rate, the instrument will offer a real rate of interest. Real interest rate is the nominal interest rate less than the inflation. If inflation increases by 10%, the face value of the bond will also increase by 110%. The investor will receive real interest of 110 rupees. The increase in the bond's principal amount protects your purchasing power. Tracking stocks. A tracking stock is a stock that tracks the financial performance of a specific operating division of a company rather than the operations of the company as a whole. As a result, if the unit or division performs well, the value of the tracking stocks may increase if the company's performance as a whole is not up to mark. Tracking stock concept is not applicable in India in view of the Companies Act 2013. Mortgage-backed securities, also known as MBS. An MBS is a type of asset-backed securities that is secured by a mortgage or a collection or pool of sometimes hundreds of mortgages. The mortgages are sold to a government agency or investment bank that securities or packages the loan together into a security that can be sold to investors. MBS assures a fixed return which is derived from the performance of the specific assets. They are issued with a maturity period of 3 to 10 years and backed by pooled assets like mortgages, credit card receivables, etc. Housing loans are widely used as the basis for issuing MBS, the loan originator or intermediary institution to ensure a minimum yield on maturity. Hybrid funds. Hybrid funds and not hybrid instruments I am talking about provide regular income as well as provide capital appreciation, a judicious mix of both the fixed income securities like bonds and debentures and also sound equity scripts. They are also known as balanced funds. Hedge funds. A hedge fund is an alternative investment that is designed to protect investment portfolios from market uncertainty while generating positive returns in both up and down markets. Hedge funds are organized as private investment partnerships or offshore investment corporations. Hedge funds use a wide variety of trading techniques and instruments, often including short selling, derivatives, and leverage. Hedge funds may pay performance fees to their managers. Hedge have an investor base comprising wealthy individuals and institutions and relatively high minimum investment limit. Hedge funds are similar to mutual funds and both entities issue units or securities to investors and holds pool of securities to diversify investment. Have professional asset manager and the same invest strategies. In this way, hedge funds are similar to mutual funds. Domestic hedge funds are those hedge funds that are organized within the boundaries of the United States of America and valued as account balances and are subject to US regulatory trading reporting and are typically designed for taxable US investors. Domestic hedge funds are typically organized as limited partnerships, business, trust, or limited liability companies in Delaware. Hedge funds structured under foreign law or located outside the US are designated as offshore hedge funds. Offshore funds are not subject to United States taxation, a way to raise additional capital from non-US investors. Offshore hedge funds are not registered in the United States or with the US Securities and Exchange Commission and offer privacy benefits as well as tax advantages. Generally, non-US citizens and non-US residents who are present in the United States fewer than 180 days a year, many tax-exempt investors such as not-for-profit institutes, retirement funds, and endowments may invest in offshore hedge funds. Both foreign investors and US exempt investors will invest in either a parallel fund of an existing US fund or they will invest in a foreign fund which is set up as a corporation. Hedging is a risk management strategy used in limiting or offsetting profitability of loss from fluctuations in the prices of commodities, currencies, or securities. Leverage funds are mutual funds using aggressive investment techniques or financial leverage such as buying on margin, short selling, and option trading to obtain maximum capital. Appreciation for investors in the fund. Leverage is an investment strategy of using borrowed money to generate outsized investment returns. Leverage funds are more risky than hedge funds about private equity funds. Private equity funds concentrate their investments in unregistered and typically illiquid securities like hedge funds. Private equity funds rely on the exemption from registration of the offer and sale of their securities. The investors in private equity funds and hedge funds include high net worth individuals and families, pension funds, endowments, banks, and insurance companies. Private equity funds differ from hedge funds in terms of the manner in which contribution to the investor pool is made by the investors. Private equity funds are long-term investments, provide for liquidation at the end of the term specified in the fund's governing documents, and offer little, if any, opportunities for investors to redeem their investments. A private equity fund may distribute cash to its investors when it sells its portfolio investment or it may distribute the securities of a portfolio company. Leverage funds are mutual funds using aggressive investment techniques of financial leverage such as buying on margin, short selling, and option trading to obtain maximum capital appreciation for investors in the fund. Leverage is an investment strategy of using borrowed money to generate outsized investment returns. Fund of funds, FOFs. A fund of funds is a mutual fund scheme that invests in other mutual funds and is designed to suit the varying needs of different investor categories based on their risk profiles, return expectations, and investment goals. Thanks for watching this full session on the capital market investments. Please like, share, comment on my YouTube channel, Legally Determined. Break a leg. Thanks and break a leg.